Hello and welcome back to The Note. More or less everything out there that you might want to invest in is expensive at present. So what exactly can you do with your money? Well, my guest today has spent a very large amount of time thinking about this. He's the head of the BlackRock Investment Institute, Ewan Cameron-Watt. Ewan, thanks for joining me once more. Let's start by taking a look at this chart that you provided. This shows where valuations for fixed income securities are compared to their historic norm. And it's quite a nightmarish scenario as far as I can see.
Well, what you can see is that if you look at the circles, they're where we were a year ago, and the bars are where we were at the end of May. So things have become a little less expensive in one or two parts of the bond market, but not really. And so bonds have appreciated in price, driven by easy policy.
And particularly in the most spectacular at the top of the list, Spanish bonds are now as expensive as they've ever been, even with all the continuing worries about Spain.
And we chose them just as a representation of what's happened with the peripheral bond yields in Europe.
So there's been a wonderful little play on that for the last couple of years.
Indeed.
It would be very unwise to expect it to.
Indeed.
Okay, now let's take a look at the same exercise for equities. And here it seems to be reasonably clear, right, that Japan and EM you can make a case for on value, the rest of the world you can't. Is that a fair?
Relative to its own history, and this is a mix of price earnings ratio, book value, and dividend yield.
Right, that's how you. Okay,
that's how you do it. Relative to own history, yes, Japanese equities look pretty good value at a time when it's more likely than not that earnings expectations there are going to rise. If you look down to the emerging markets, they're cheap against their own history, but that possibly tells you a little bit about some of the bubbles we've been through in that asset class in the past.
Yeah, the history is not less complete; it's less.
It's shorter, although in some cases you're getting up to 20, 25 years there now. And if you look at the European markets, you can see the core markets have got more expensive, but still a little bit of upside there.
Okay, now we hear a lot about the hunt for yield, and part of the reason these securities might be expensive can be explained by this next chart. Not so long ago, there were any number of ways of getting yourself a yield of more than 4%, and that is dwindling ever further down. What effect does that have on other markets?
Well, it has one good and one bad effect. The good effect is it reduces the cost of capital across the board, and the bad effect is that it reduces the cost of capital across the board.
Right.
And the former, of course, is helpful, which is one reason why European equities have done so well. And the latter leads into perhaps poor issuance quality starting to come forward.
And given that we only have those two asset classes, emerging markets and global high yield, that will still offer you 4%, is it fair to fear that that quality has gone down in those assets?
I think it's fair. That's one way of putting it. Another way of putting it would be that to get the yield that you need, you're taking more geographic risk. And you're probably taking more credit risk as well.
Okay, now this all leads to equities. This one big demonstration of why equities managed to keep going up despite this much widely disliked rally. This is a fascinating chart. You've compared world equities with their earnings per share.
Yeah.
Basically, is it fair to say, therefore, the last leg of the rally has gone on with flat earnings? Do we need earnings to rise again if this rally is to be sustained?
I think that you do ultimately need earnings to rise. I mean, what's happening here is that the reason the price of the assets are rising faster than the earnings is that people are becoming more relaxed about the volatility of the factors that affect earnings. And if you think about an equity, it's the final claim on the cash flows of a company. If you reduce the volatility and the cost of a lot of those intermediate claims, like debt costs, like employment costs, more falls to the bottom line, but more importantly, with lower risk. And so you pay a higher price for that lower risk. And that's what's happening here.
So I guess for a final question, does this mean ultimately stick with equities for the time being, that there is still more juice in that lemon?
Companies are starting to leverage up, both for M&A activity, for buybacks. They're beginning to spend a bit more money on their businesses as well, which is something it would be great to see more of. And the question is, do you want to be the person who's paying for the present, the bondholder, or the banker who's lending the money, or the person who's getting the present, which is the equity shareholder?
Okay, thank you very much indeed, Ewan. I think that explains the very strange logic of the current situation quite beautifully. There are any number of good reasons to be nervous about equities at the moment and their valuations, but the logic of the situation still points ineffably towards equities.